Hello, thank you all for joining our session. My name is Mayara Correa. I am Market Development Manager at ICIS for Latin America, and I'm based in São Paulo. I would like to thank APLA for the invitation and send my congratulations on the organization of the event. Well, most of you already know ICIS and the global presence. And about 2 years ago, ICIS opened the office in Latin America to create proximity with the regional markets. ICIS stands for Independent Commodity Intelligence Services. We are a global source of information for chemicals, energy, and fertilizers. We connect data, markets, and customers to create a comprehensive and reliable view of global commodity markets. This enables smarter business decisions that optimize the world resources. This year, ICIS had exciting development that was the acquisition of the company Chemical Data, known as CDI, powered by a team of industry experts with extensive experience. So together, we deliver deeper and comprehensive insights across the global chemicals and plastics value chain when it's needed the most. This news demonstrates our joint commitment to supporting the chemical industry to make better informed decisions and bring significant benefit to our industry. For today, in our session, ICIS team will share with you about macroeconomic and trends that will be presented by Joseph Cheng, Global Editors at ICIS, followed by Renato Frim, Senior Markets Editor for Latin America, who will present about polyethylene and polypropylene markets in LATAM. And then we'll go through what's ahead for next year with Alex Lidbeck, Vice President at CDI ICIS. In the end, we'll have a live session for Q&A, so please submit your questions and we'll be glad to answer them. Now I leave the stage to Joseph Cheng. Over to you, Joseph.
So thank you, Mayara. I'll talk about the global macroeconomic outlook and key trends in petrochemicals. So we all know the devastating impact the coronavirus has had on all economies all over the world. You can see this impact on the global manufacturing sector in the PMIs, the Purchasing Managers' Indexes. Here, we look at the key 3 regions, the US, Eurozone, and China. Anything over the 50 level indicates expansion in activity, and below is contraction. So even before the coronavirus pandemic, global manufacturing was already weak. Then you see the plunge in all 3 regions because of the lockdowns, first in China and then everywhere. And then you see the sharp V-shaped recoveries in all regions. Through September, all 3 regions are in expansion territory for the 3rd consecutive month. And you can see things have rebounded much faster than in the financial crisis of 2008 to 2009. This is an encouraging sign for the near and medium term, as the PMIs are a key leading indicator of industrial production. On the next slide, I want to highlight the strength in U.S. automotive and housing, 2 key end markets for petrochemicals. Again, you see the V-shaped recoveries. Now, the U.S. auto sales are not quite back to pre-pandemic levels, but you can see even before the pandemic, sales had already peaked and were trending lower. On the other hand, U.S. housing starts were already trending higher before the pandemic and are now firmly back on that uptrend. Overall, big improvements in these important markets bode well for chemicals demand in the U.S. going forward. In the next slide, we can see the monthly trends for China and European car sales. So China has been exceptionally strong and is now well above pre-pandemic levels after 6 consecutive months of year-on-year gains. China has been able to control the coronavirus outbreak better than many other countries, and its economy is back on track. Europe has also climbed back from severe declines during the lockdowns to show the first year-over-year gain in September. Again, these are encouraging data points for automotive, a very important end markets for chemicals. Now, I want to turn to Brazil's automotive market. Brazil had a severe recession in 2015 and 2016, and the recovery has been weak, so car sales were slow even before the coronavirus hit. But here you can also see the recovery in sales as well. By September, Brazil's auto sales were back to year-ago levels. Next, let's look at global GDP forecasts by the IMF for 2021 versus 2020. Now, after a global recession in 2020, economists expect a rebound next year. There are hopes for one or more effective coronavirus vaccines and therapeutics by early next year. Plus, central banks have taken strong, quick action, cutting interest rates toward zero and flooding the financial markets with liquidity. Governments have also stepped in with trillions of dollars of stimulus spending to mitigate the damage from the lockdowns. And here you can see the expected recoveries in GDP. Now, Latin America is expected to suffer more compared to the rest of the world in 2020, with an 8.1% decline in GDP. And then in 2021, the IMF expects its rebound to be weaker than in other regions. So while the outlook for 2021 is encouraging, risks remain as a second wave of coronavirus cases is emerging, especially in Europe and the US. Really, economies won't be able to fully recover until people feel safe moving around and engaging in activities without social distancing. On the next slide, I want to highlight some key macro trends in global petrochemicals. And so the first is big cuts in capital spending, or CapEx, among both oil and chemical companies. Now, this started actually before the coronavirus pandemic as crude oil prices collapsed, along with chemical prices. Oil companies are cutting 2020 capital budgets by up to 30%, which is also impacting their petrochemical expansion plans. Chemical companies are likewise pulling back. And by the end of the year, CapEx will likely fall even lower than budgeted. Petrochemical project timelines have been delayed, as well as final investment decisions. And what these big capital spending cuts does is really sharpen the focus of companies' investment plans. Now, another key trend, and in line with the sharpening of investment focus, is the localization of supply chains, keeping production closer to home. Dow CFO cleverly called this minimizing molecular tourism. You'd rather not have your molecules traveling long distances. So instead of building plants to export products for long distances, say the US to China, more and more companies are planning to build where the demand growth is. And increasingly, that's going to be China and India. Why is this happening? Well, you had the US and China start a huge trade war with tariffs on hundreds of billions of dollars in trade, including chemicals and plastics. Protectionism all over the world is on the rise, and so everyone is worried about trade barriers. Companies are also focusing on costs, and logistics costs can often be 2 to 3 times the cost of converting monomers into polymers or emulsions, Dow CFO has said. And third, COVID-19 brought supply disruptions into greater focus. It became more important to have surety of supply and shorter, more local supply chains. I think you'll see more direct investment in the high demand growth areas, so less in the US and less in the Middle East. Even Saudi Aramco and ADNOC, that's Abu Dhabi National Oil Company, are targeting India for their next mega cracker project, while ExxonMobil is looking at a big project in China. Russia's Sibur just broke ground on a huge project very close to the border with China to make 2.3 million tons of polyethylene. And LyondellBasell's Bora joint venture will also make polyethylene and polypropylene. LyondellBasell CEO Bob Patel said, "The thesis around that investment is producing in China for China." Now, this is a completely different business model than producing in low-cost feedstock regions to export around the world. In the next slide, you can see the US ethylene investment wave. So starting in 2017, because of the cheap shale gas feedstock, producers boosted US ethylene capacity by 10.9 million tons a year through 2020. But from 2021 onwards to 2024, the second wave will see far less capacity come on, less than half. It's very difficult to justify spending billions of dollars on new US cracker projects because of low oil prices, which erodes the competitiveness of ethane crackers, as well as trade and economic uncertainties. Now, just recently, Sasol agreed to sell a 50% stake in its brand new Louisiana cracker to LyondellBasell at a steep discount. It's unlikely we'll see final investment decisions or announcement of new US crackers anytime soon. On the next slide, it's a different story in China. While US ethylene capacity additions will decline, China is set to bring on huge amounts of capacity. It is seeking to become more self-sufficient in polyethylene in particular, rather than relying on imports. China is still the world's largest importer of polyethylene by far. By 2021 to 2024, China could bring on 16.4 million tons a year of ethylene capacity, with plenty of downstream PE capacity as well. And here on the next slide, we show the US and China together for ethylene capacity additions. You can see 2020 will be a pivotal year where China takes the lead. So from 2020 onwards, at least through 2024, China will dramatically outpace the US in new capacity. Lastly, there's another important trend, and that's of European oil companies making a massive pivot to green energy. And now that's solar, wind, batteries for electric vehicles, electric vehicle charging stations, biofuels, and hydrogen. France's Total and the UK's BP are among those leading the charge, but others are also taking big steps. Now, what's driving this? Well, first, it's the EU's European Green Deal, which aims for zero net greenhouse gas emissions by 2050. This is forcing companies to cut their carbon footprint. But the most important driver is the rapid advancement of electric vehicles. Technology is making them cheaper, and the consumer mindset has shifted as well. Younger people in particular want their next car to be an electric vehicle. This adoption of electric vehicles will happen faster than many people expect. Changes in consumer behavior can happen fast, and once they move to EVs, it's unlikely they will ever change back. So oil companies are realizing that oil demand for transport fuel will decline, and some, like Total and BP, plan to aggressively invest in renewables and the EV mobility chain. If more oil companies prioritize investments in green energy, that means potentially less investment in petrochemicals. Also, we're seeing refinery shutdowns and conversions to lower capacity biorefineries in the US and Europe, and that's going to reduce naphtha feedstock supply. More plastics recycling will also mean less demand for virgin plastics and thus less oil demand for petrochemicals. So you can see why some oil companies are making these radical changes in strategy. Not all are. So far, the major US oil companies have not shown enthusiasm for such a strategic green shift. Now, in this last slide is a list of recent biorefinery conversion announcements. It's been in the US and Europe. The coronavirus crisis led to a plunge in fuel demand in an industry already suffering from overcapacity. So in these announcements, you can see in yellow that the new biofuel capacities are far less than the original refining capacities. So when you hear about biorefinery conversions, it's never just a like-for-like replacement. It's almost always going to mean big reductions in fuels capacity. And there should be more of these to come. Thank you, and I'll turn it over to my colleague Renato Frim to talk about the Latin America polymers outlook.
Hi, I'm Renato Frim, Senior Editor at ICIS, focused on the Latin American polymers markets. I'd like to thank APLA for hosting this event and all attendees listening to gain insights into Latin petrochemical markets. First, let's talk about US ethylene, polyethylene feedstocks, where spot and contract values of these feedstocks are higher than their January levels. Due to extended power outages as a result of Hurricane Laura, about 16% of US production capacity has been offline for several weeks. Until the power is restored, resuming production will remain at low levels. As for high-density polyethylene, in the region, prices are higher than their January levels, as these markets have tightened considerably on increasing durable goods demand. As for low-density polyethylene, prices are also higher than their January levels, and demand for film applications has remained strong on packaging needs for food, medicine, and hygiene products. Some deliveries are being described as delayed or not in full. Asian imports remain competitive. Slower but improving demand for automotive, construction, and industrial industries is tightening these markets further. About 32% of global packaging consumption is polyethylene derivatives. U.S. export prices have increased dramatically as resuming production has been delayed due to hurricane outages. High-density polyethylene, major imports coming from the United States to the tune of 760,000 tons this year, and low-density polyethylene trade, where 470,000 tons have been imported from the U.S. this year. Polyethylene demand is expected to continue outperforming the broader economy on essential food, packaging, and non-durables consumption. Ethylene feedstock supply is expected to lengthen in the last quarter this year as cracker maintenance and production outages return to normal levels. Regional polyethylene producers will likely increase operating rates as feedstock availability improves and demand continues strengthening. New capacity construction in the U.S. is facing some coronavirus-related delays, but will add to supply in export markets in the short run. And now we'll move on to discuss propylene and polypropylene markets. First, looking at U.S. propylene, prices are above their January 2020 levels as Hurricane Laura reduced U.S. productive capacity for propylene by 11%, and extended power outages have delayed resuming production. As Hurricane Delta has also added an additional week to those delays, feedstock propylene markets are tight. As for Latin American polypropylene, prices have risen to or above their January 2020 levels on limited production and supply availability due to outages in Chile, Argentina, and reduced operating rates in Brazil. As I've mentioned, supply is extremely limited for polypropylene on reduced operating rates. Braskem's new Delta project has started test phase production. Demand for BOPP films on packaging needs has been extremely strong. Non-woven applications for personal protective equipment are also good. Demand is improving for other sectors, including construction, appliances, and automotive, and other durable goods. Reduced availability and maintenance outages have limited feedstock availability and polypropylene production. U.S. spot and contract propylene rebounded from April lows at historically low crude levels. Majority of propylene source is from naphtha or LPG, whereas vapor cracking of ethane or natural gas liquids will produce a smaller proportion of propylene feedstocks for polypropylene. Here I'll show a list of all the production outages that have recently occurred, leading to these extremely tight markets. As for global polypropylene trade, specific to the Latin American region, 1/3 of imports come from Asia, and roughly 2/3 of the rest of the imports come from the Middle East. Improving polypropylene demand and shorter supply are providing upward pressure on prices in the short run. Propylene feedstock supply is expected to lengthen as maintenance and outages return to normal levels of production. Regional polypropylene producers will increase operating rates as feedstock availability increases, and demand continues improving for the slower sectors. Once again, Braskem's Delta project will provide an additional supply of the tune of 450,000 tons per year. Now I'd like to share with you Latin American economic projections, Brazil's industrial activity, and flexible packaging in Brazil. This first table shows all countries in Latin America are expected to contract in 2020, followed by modest growth rates in 2021. The region as a whole will contract by 8.1% this year, followed by a modest growth rate of 3.6% in 2021. Globally, GDP is expected to contract by 4.4% in 2020 and increase by 5.2% in 2021. Brazil's industrial activity by sector shows a sharp drop in durable goods demand in April, followed by a V-shaped recovery as automotive industries resumed production and industrial and construction demand returned. Also, Brazil's flexible packaging industry is dominated by food applications, followed by industrial products and disposables.
Hello, and thank you for joining us today. 2020 has been an unbelievable year, to say the least, and I think we would all agree that we can't wait for it to finish. But the next question is, what should we expect for 2021? And in today's presentation, I'd like to touch on what our views are on 2021 and what the new year will bring to us. So today I'm going to start with oil prices. Oil prices are still integral to setting chemical prices around the world. Its feedstocks, related to naphtha and also LPGs, are key drivers for chemical prices around the world. So I'll touch on oil, some of the U.S. feedstocks, but the majority of the presentation will be focusing on North America, polyethylene and polyprop. There's some dynamic changes taking place in those markets, and I'll touch on those and then wrap up our presentations before we head into the Q&A session. So let's start with oil prices. Brent oil prices obviously collapsed with the pandemic. Oil prices dropped significantly as demand for oil and refined products was collapsing, but at the same time, Russia and Saudi Arabia went into a price and market share war, which drove prices down even further. Since then, they've stopped the market share war. OPEC Plus got into some supply cuts. There's also been a reduction in rig counts, and Brent prices have stabilized around the low $40s per barrel. Our view is that it remains around this level or maybe into the mid 40s well into next year because there's plenty of oil supply in this market. There's still a lot of inventory around the world. It's going to take time to get through these inventories, and we expect by the second half of next year, with the curtailment in production, the reduction in rig count and capex, especially in North America, and as demand improves, that's when the market will begin to go into better balance and the prices of oil go higher into over $60 well into 2022. For NGL prices, starting at the top there, butane and propane are closely linked to oil prices, always measured against the percent of those prices relative to oil, and they'll swing some, but oil has a big influence. And then on top of that, you have some seasonalities that come, whether it's driving season for butane or heating for propane. You have some swings, ups and downs, but you can see overall that they trend higher along with oil prices. Ethane at the bottom there, the dark blue, those prices trend higher as demand for ethane improves and concerns around supply because of the lower rig count, lower oil production means lower associated gas, that we have the ethane prices trending higher throughout the forecast period. It's going to be in a better balanced situation in our view. So let's look at polyethylene because that's really what the main interest is. So this chart here is to summarize really 2 3-year periods. So the last complete 3 years of 2017 to 2019 and then 2020 to 2022. The green bar shows demand growth over this period, and the blue shows capacity additions. And what I want to highlight here is just the big difference that we're seeing here. So when you look over the last few years of 17 to 19, there's been a lot of capacity that's been added. Look, at no time was there any expectation that all this capacity would be absorbed in the domestic market. The domestic North American market is very mature and demand growth is slow. These units were built for the sake of exporting. So there's excess capacity of almost 5 million tons over the last few years. And in the forecast period, while it's not as much, it's still another 3.6 million tons of excess polyethylene capacity additions relative to demand growth. So over this 6-year period, it's 8.5 million tons of excess polyethylene capacity in the US and Canada alone. So it is going to have to be exported, and it has been exported. Let's look at exports for the 3 different polyethylenes starting in 2010. So from 2010 to 2014, around, say, a little under 4 million tons, saw a little bit of a bump in 15 and 16 with new capacity. In 2017, the exports came down, not because of more capacity, but because of supply disruptions surrounded by Hurricane Harvey, which hit the Texas Gulf Coast area quite hard, and it impacted production. Once those issues were resolved and further capacity came online in 18 and 19 and beyond, the exports of these polyethylenes has continued to increase, and we expect that it's only going to increase because of the excess capacity additions. The green line shows the amount of polyethylene exported relative to production. And I want to be very clear that we expect high operating rates for polyethylene. It'll vary across the 3 different polyethylenes, but to say that it's around 90% is not an underestimate. And with those kind of run rates, by the end of the forecast period, it's over 40% of all production of polyethylene in the US and Canada will have to be exported to sustain those operating rates. So it's important that the US is an advantaged cost position. We do believe it will be there. Maybe not as advantaged as it once was when all these projects were approved, but still advantaged. Now let's look at exactly how advantaged it is. This is a snapshot for October of 2020. Conditions have been actually a little bit better as of late because of improvement in demand, primarily in Asia. But if we work our way from left to right, the Northeast Asia price for polyethylene in the low 900s, we deduct ocean freight, bagging and port costs, conversion costs to polyethylene, and then ethylene production costs. Where once you net back all those costs to the polyethylene price for an integrated producer, margins are around $350 per ton. Granted, these are single-digit return on investment, and these are nowhere near reinvestment levels, but it's still a nice return. These are units that are already in place for the most part. They're in place, they're going to generate a decent return, and they are going to run. And that's why exports have been so high. Let's do the same analysis for polypropylene. The scale is smaller just because the market is smaller. Now, the excess capacity is not as big, and especially the last few years, it's only been 285,000 tons. It really hasn't impacted too much the market. Right now, we're seeing new capacity that's started up. There's a little bit more coming up, and what you can see here is that there's an excess capacity of around 1 million tons of polypropylene from during 2020 to 2022. So this is changing the dynamics of the market for North America. Let's look at 3 periods here. So let's start with the first 4 years here. North America was actually a net exporter of polypropylene. But as prices went up in North America and the market tightened, it actually moved into a net import position over the last 4 or 5 years or so. And you can see what it's pretty extensive in terms of a net import position. Now, from 2020 to beyond, with all these capacity additions, our view is that polypropylene shifts back into a net exporting region. Now, what does all this mean to pricing? First, let's look at the monomers for polymer-grade propylene and the ethylene price. We've seen a jump in recent prices for these 2 products, and a lot of that has to do with the supply disruptions that stemmed from Hurricane Laura that hit primarily the Lake Charles area. There's been a lot of supply disruptions, and it'll take the better part of the 4th quarter to get those back in line. Now they're behaving a little bit differently in that polymer grade propylene comes down a little bit, but then begins to go back up. And part of that is because of the extensive polypropylene capacity additions will result in increased polymer grade propylene demand. Ethylene, on the other hand, there's plenty of excess ethylene in the market. Once these supply production issues are solved, we expect it to come back down. Not as low as where they were before, but part of that is because of remember from earlier, the higher ethylene prices, which means higher costs of producing ethylene. So as a proxy here, just to get an idea of the profitability of the ethylene industry, these are spot ethylene prices, the line, and then the bars are the margins. We saw a dip in early 2019. There were some issues there surrounding just excess capacity coming on. That rebounded a little bit. They came back down, the margins, with COVID. Now they had a nice little spark in margins because of Hurricane Laura and supply disruptions. But again, we expect that will be solved during the fourth quarter, and that margins will come down to lower levels, but remain positive in the forecast. So what does this mean to polyethylene prices? Let's start here with, we look at high density polyethylene. It follows a similar pattern. We've seen a big jump in polyethylene prices. Again, polyethylene is long. There is plenty of capacity, but the supply disruptions of late have tightened the market and prices have gone up. Once those supply issues are resolved, we expect some correction in polyethylene prices, and they kind of go sideways over the forecast period, partly supported by the higher ethane prices, ethylene production costs. But at the end of the day, there is going to be an integrated margin squeeze to take place from where we are today. Polypropylene prices, they come down a little bit and then they kind of go sideways. Now, the interesting thing to remember is from the previous chart is that we have polymer grade propylene prices actually going up, while polypropylene prices stay flat. And the reason that is because of the additional capacity is going to put pressure on polypropylene prices, which will result in a little bit of a margin squeeze for polypropylene as polymer grade prices go up over the forecast. So to kind of sum things up here, polyethylene, there's excess capacity in the marketplace, and it's going to have to be exported. Oil prices are key to setting prices of chemicals around the world, and from a U.S. perspective, low oil prices are not good. The higher the oil price, the higher chemical prices. The higher the oil price, the more oil production, the more associated gas, the lower ethane price. So it is a negative impact, but I do want to say that over the long haul, we do expect that North America will be in a good position to produce ethylene and derivatives and to export around the world. And it will be able to do so as demand improves. So to sum things up from a macro basis, global GDP is expected to continue to recover in 2021. Manufacturing, automotive is improving. We're seeing that already. We expect that it'll continue to go up. We'll see a little bit of a shift where the U.S. will, in the long run, reduce some of its investments in ethylene and derivatives, and we'll see more investments in China as that country tries to become more self-sufficient. One of the dynamics that changes on the oil side is also that some of these European companies are switching over to more kind of greener energy and putting less focus on the petrochemicals market, which in the long run will help rebalance the chemicals market. Latin America, demand for polyolefins is getting better, and we expect that it'll continue to improve as the economies improve and durable goods improve into 2021. For North America, there's excessive capacity additions, higher exports, obviously, especially as a percent of production, especially for polyethylene over 40%. And the international price is going to have a much bigger influence than it had, say, 5 years ago. And demand is going to continue to improve over time. Now, that's all I have today, and we'll be happy to take some of your questions. Thank you for your time and attention.